Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 7th, 5:28 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week. It was a hell of a week, actually. Take a look ahead at key levels for next week and update the world famous 21 over 21 leaders list. When we closed last Friday, we had one stock left on the leaders list. That was BTU. Actually, I think FSLR probably still was on it too. But by the middle of the week, in fact, by when I closed yesterday, I had over 40 stocks on there. I probably could have had 100 if I'd have included all the oil stocks that were looking good. But as you can see by the red lettering and numbering on the agenda for today, the reaction to the jobs report was really not good. We gapped down and trended down, and 2121 list got easily cut in half. I do still have 21 stocks on it, and that's excluding a bunch of oil stocks, but that's a separate issue for discussion. But not what we're looking for very clearly. This flag that was forming below the 21 broke down. That ends the correction, so not showing in green bear market rally anymore. That was an abject failure with not only the gap down, but the continued trend down day. 11 out of 11 sectors down. That's distribution. And we regroup. We're back to all cash. We regroup, and we'll see what the market brings the next day, the next week, the next month, and the years into the future, because this is what I do and I love it. So let's get to the trend gauge. Market leader still showing on neutral. That's because I have a fully populated 21 over 21. The sub arrow at red because the technical indicators that were positive at the beginning of the week because of the stochastic turn up have hooked down. So that tailwind is gone, and all of the moving averages back below their short-term moving averages on the major indexes, back below their short-term 21-day exponential moving average, their medium-term 50-day moving average, their long-term 200-day moving average. We got stopped or had either stopped out, or I just decided what's the point in being in small positions in something when the wind is in my face. So we closed everything out today, and we'll go over those tickers and those trades. Then we will also go over the tail of the tape and the 21 over 21 list. So let's get right into it. First of all, let's talk about today's final numbers. I mentioned the gap down and the trend down. You can see here G6 had been showing some life, had been outperforming, undone today, down 3.6%, S&P 500 down 2.8, NASDAQ 100 down 3.8, Dow down 2.1, mid-caps down 2.5, Russell down 2.9, 60/40, global diversified, stock and bond down 1.8, in-house we're down 1.11. Stopped on a lot of things before 10 o'clock and shut down the rest late morning, early afternoon, as the market was just trending lower, no bid whatsoever. We did finally get a short covering rally the last 25 minutes, and we ended up just about at the same level, 36.40, where we went to all cash. So let's explain, first of all, our strategy here at Revere. This is what we do. We're trend followers. When the market, in this case, I'm showing the S&P 500, when price is trending above the short-term 21-day moving average, that's the green line, above the medium-term 50-day moving average, that's the red line, above the 200-day moving average, that's the black line. We are fully committed to the market as long as we're happy, content being, as long as we're not getting sell signals on individual stocks. We're doing a combination of offensive selling, defensive selling, and riding the wave. You never know how far the wave is going to go, but when the wave starts to end, we're prepared. Our stops will take us out of the market, and we go sideways. We'll pull back a little bit to about even risk with the market. When we start rolling over, though, meaning the slopes of the lines of the 50-day moving average and the 21-day moving average roll over, and we get beneath them, a big flashing red light was here on January 18th, and by January 24th we went to cash for the first time this year, and that was our first close below the 200-day moving average. Over the next 2 months we played volleyball, badminton, whatever you want to call it, going back and forth around the 200-day moving average. We were primarily in cash, dipped a couple of toes in the water, stopped out, but then the big change came on April 21st. Tried to get back above the 200-day moving average, failed miserably with heavy volume, closed at the bottom of the range, and that was the first time that the 200-day moving average slope of the line turned lower. It was a very serious selling over the next 4 or 5 weeks. Before we tried to get back above the 21-day, we made a little entry here, that failed, made a little entry here, that failed, little one here, but this little one here had legs, and we carried it higher until we ran into the declining 200-day moving average, in which case our stop started taking us out again. A couple of false starts. This undercut and rally, which hasn't completely failed yet, but for all intents and purposes and the way we were playing it, it failed. You had an undercut on 9:30, a reclaim on this Monday, a gap up on Tuesday, and then 3 days we could not get above the 21. That's not out of the ordinary. After a 6% move up off the bottom, we were putting in a little bit of a flag here and waiting on the jobs report. But the jobs report was just okay, and market didn't want okay. It wanted a weak jobs report. It's looking for any signal that the Fed will stop raising interest rates and that inflation is under control, and we certainly didn't get that today. And if you look at a 15-minute chart here, you can just see the gap down, and then this is just broad-based selling, gap down and trend down. And as I said, back to cash. And certainly not what we were looking for in the market. But we've got clear rules. We've been getting a lot of nice feedback from people saying it's so clear, it's understandable. I get what you're doing. You'll be active. You'll be in the market when the market's going up. You'll be out when it's going down. There'll be different levels of participation depending on the strength. And we've gotten a lot of new clients over the last quarter, and those clients have protected their capital. After our first, we don't just sit around doing nothing collecting fees. After our first move to cash on 124, there have been 13 total times throughout this period that we've started back in and then gone back to cash. It ended up that we've lost about 5.5% during this time. The market has lost 18% during this time. So you can't say we're getting chopped up and losing substantial amounts of money to do it. The risk is measured. This last foray in, we lost about 1.5% before we got fully stopped out. That's in line with what we wanted to. The stocks stopped out was less than the 1% that I target. The VU, the SPXL, the UPRO entries, they stopped out for a net about 0.8%. So total loss of about 1.5%. Not the best result, very clearly, but still down below double digits for the year, while the market's down 23% again. And we'll take more. The market never gives you an all clear signal ever. And if you think you finally got one, you probably missed the bulk of the move until it gave you that all clear signal. And I can tell this by going through years of risk on, risk off signals of where we are relative to the moving averages, the gains that can be made during big moves, the losses that are required to be taken to get on the right side of the market and stay on the right side of the market. And we've got a net profitable system, so we tweak it every now and then. Big tweak happened last February, March, April, after we underperformed because the indexes held up, but growth stocks went into a severe bear market. We learned some lessons from that, implemented them, and that's really been responsible for a lot of the quick loss cutting that we've been doing, getting in and out this year. And if you're interested in an approach like this, I can explain it further. Reach out to me. Email me, don@revereasset.com. You can also email dan@revereasset.com, or you can phone 855-REAL-WEALTH. That's 855-732-5932. A common sense approach like this, participating in market uptrends, getting out of the way in market downtrends, not just saying, that's it, we're out. We'll dip toes in the water. We'll actually fully submerge in the water the way we were here in this last run up, but it was stopped at the 200-day moving average and ended up coming back, making new lows. The indexes did, and it's just a tough market. But we do know this is the United States of America. The golden goose of capitalism will at some point right itself. Inflation will get under control. It might be difficult. We might have a very severe third leg down. We don't predict, but right now we're positioned that if that third leg down hits us, we'll be just fine because we're all in cash. And we're looking for instances of when we can get good short entries on various instruments to actually make a few percent while the market's going lower. And like I said, if you're interested in this approach, reach out. So that's the S&P 500. That's where we look on that. Let's go through the other four major indexes. Here's the NASDAQ 100. Tough day today, down 3.8%. Still hasn't completely undercut the low from last Friday, 9:30, but certainly not looking good. Let's go to the Dow Jones Industrial Average. Still hasn't undercut last Friday. But again, we're consistent on the averages, all of the major averages, the three main that we track. And in fact, now the ADMA has rolled over with the break today in these moving averages, as well as this hook in the stochastic. That's a negative. So really, it was the breakdown of this little flag consolidation pattern that we were looking at caused enough technical damage and enough price damage to get us out of the way. MDY mid caps, same situation, consolidating, failed, and IWM small caps, 2-day consolidation after a 2-day up move, failed. So back to all cash, protecting our capital, and we'll see what next week brings. Let's go to the tail of the tape now, and we'll discuss what changes made. So for obviously market state, bear market rally taken off, same headwinds. Technical, the daily stochastic oversold hookup failed. So we're still operating under the bear case. We never reclaimed the 21 on all the averages, never really initiated a rally. As from an IBD perspective, arguably you did for small and mid caps, but that failed also. So we're still operating under the bear case. The news, I already discussed it. By the way, the pivot for the jobs report is 37.46. This is what we were at 8:30 this morning, pre-market, before we immediately gapped down and then started heading lower. And the result of that jobs report, the reaction was stocks down, rates up. We went to 2 days up with 2 days consolidating to the first down day. Expectations neutral coming in because we didn't really know what was going to happen with the jobs report. Those obviously have flipped to negative with the gap down and the trend down. We did hold support in both cases, barely on the NASDAQ, gapping below the support resistance area that we've been going back and forth around this week. So the support range held on both. Just barely. As I said, gap down 1.2% at the open, trend down 335, short covering bounce. Here are the ranges on the day. Only thing I could find that was up, of course, the US dollar and oil was up, but oil stocks were up most of the day, but then flipped to negative. Pot stocks appears yesterday was a short covering rally. They were higher early, turned to red after that big up day yesterday on the Biden marijuana proposal. Bonds down on the day, which means rates up. 11 out of 11 sectors down, led by stocks. AMD warned after hours yesterday. That certainly didn't get things off to a good start, and it ended up down 14% on the day. Things are never too low to sell, people. They can always go lower. Software very weak. Gold stocks, which had been a darling over the last week and a half, down 4.91% today. Biotech down also. Let's take a look at those gold stocks really quickly. Here's GDX. Holding on to the 21, you can see this move up. Really just a normal reaction. Nobody likes being in something that's down 5 days. And the down volume the last 3 days has been lower than the up volume for the 5 days. So these haven't completely broken down. And from a low to high move, low to high, the amount that we've pulled back is still within reason. for it to be just a reaction lower, not a breakdown. Notice that the stochastic did turn lower from overbought, however, so that's a bit of a red flag. So I did want to mention that relative to gold stocks because they had been acting well. Coming into today, focus on AEHR. This is Silicon Carbide Test System company in the semiconductor equipment industry. Great earnings report. They made a profit versus a loss this time last year in the same quarter. Sales almost doubled, up 89%. Stock was up 24% on a day like this with 572% value. I've talked about how this is a thin stock, but it's giving me stock envy, and really acted well today, and something we need to pay attention to. And then also watching relative strength in the recent leaders. Some of them broke down, some of them didn't. As I said, we still have 21 that we're going to look at here shortly. Indexes versus the declining 21 and rising 8. Obviously, that broke down, and we sold everything today, starting off with VU. This is basically the S&P 500 gap down. Let's take a look at the intraday action on this, and I'll discuss what I'm thinking as this happens. So first of all, you have the gap down, and it holds for a little bit, and then it gives way. So first of all, the breakdown after this opening 15-minute range, we sold half of it, and then we came down and bounced. And now you're looking to see what's the quality of this bounce. And the quality is not so good. We couldn't fill the gap here before we started rolling over, so we got rid of the rest of it. Then that left us with 5 stocks right out of the gate because of it. The biggest risk, the highest ATR stock was Wolf. When it gapped down, we sold half of it right away, sold the other half when it broke below the 21-day exponential moving average. MTB, this is the only one of the 5 that is higher from where we sold it. Had a really strong close, but an ugly open. May just be a rally into the 50-day moving average, and it can't go higher, but note the relative strength is at an all-time high. We sold that 6% position. All of these were within our tolerance for the size and the target that we set for risk control. As I said, we got stopped. We've actually gotten stopped on 7 total stocks over the last week, because we came in all cash, and as I said, it's been less than a total percent loss on those 7 stocks. And then in addition, the VU, UPRO, SPXL loss and about another 0.8%. So stopped on MTB. The next one, CEG. These held up well early, but then they started giving way, and at some point you just have to acknowledge that the flag broke. Why are you in stocks even if they're outperforming? The wind is now in your face. Just go to cash and wait for better days. You don't have to fight the market. So we sold CEG. Here you can see it's below the 21. We sold LLY, which we just bought yesterday, and this is still above the 21. But again, at some point, the last 2 sells, Lilly and CF. CF actually a tiny gain on this. Strong stock in the market. Look at the relative strength over the last 2 weeks. Certainly the research that Michael did to this led me to have some more conviction in it than I normally would have had, but conviction in the face of negative price action of the overall market. Wouldn't surprise me if this goes higher, really acting well, but we don't want to be looking for the needles in the haystack that are holding up and just hoping that they stay up when the market looks terrible. Wait for the wind to be at your back. So that's it for those 5 stocks. Let's wrap up the tail of the tape, and then we'll get to the 21 over 21. We can see what survived. So selling everything out, all cash. Bottom line, an okay jobs report prompted a gap down and a trend down. Here's where we closed today, back below this 37.15 to 37.30 big support area, back below it. And we tested and held this 36.36, 36.47, the lows from 6.17 and 9.23, still above this big area between 35.75 and 36.14. See if that can survive next week. I'm not going to predict either way, but things certainly don't look good. And if we're going to accelerate this third move down, I mean, very clearly, let's just put all pretense aside. This is not a good reaction to a jobs report. We're hoping for good statistical data. We didn't get the statistical data, and we're not the market wasn't waiting for the next data piece. The market sold off, plain and simple. I don't like it any more than any other bull does. We had exposure. Our exposure was 0.68 coming down, so about 2/3 of the S&P 500. We got out early. We lost 40% of what the S&P lost today. So there's going to be paper cuts, but again, one good trend pays for them all. We've been through it before, and the golden goose of capitalism will rise again. So there's your tail of the tape. Now let's go to the 21 stocks that have survived. And as I said, it could be a ton more oil stocks on here, but we've got 11 sectors, 18 industry groups represented. We're going to sort them by industry group ranking. So no surprise the LNG is at the top. Look at that, 7, 8 straight up days. 9, my eyes are getting old. 9 straight up days on LNG in this market, pretty good. Vertex is just kind of hanging in there, not making much progress, but it is forming a nice tight long base. But you can also be too tight for too long, and then one day you wake up and you gap down below all support, like happened to the the waste company stocks. Look at what happened to Waste Management yesterday, and showing relative strength, and then 2 days like that, WM, WCN. And I'm getting off topic here, but look at the destruction there. And yesterday, you wouldn't think that there's any reason for a defensive stock like that, and that's why we just don't try to hide money in defensive stocks and think we're going to be fine, because the market will get them too. NBIX, Neurocrine Biosciences, tried to break out, make new highs yesterday, reversed. Still above the 21 though. All of these are, or they wouldn't be on the list. SRPT sitting right on the 21. Failed attempt to move out yesterday. Dino, acting well, as are most oil and gas stocks. HLIT, Harmonic, great looking stock. This and AEHR have my attention, but they're very thin. BTU, coal stock. Michael was going to do coal stocks on the podcast this weekend, but we had some technical difficulty, so he's going to talk about them next week. He's got some really good info. Exxon Mobil, near all-time highs, above 100. Lamb Weston, packaged food. So if a packaged food, does it get more defensive than that? At the top of a base, showing relative strength. Some pretty good numbers, actually. LPLA, pie chart company, but you can't argue with the price action, although I wouldn't buy it. It'd be like a lung cancer patient buying a cigarette stock. Just not going to happen. Humana, managed care, holding up well. Molina, another managed care company, looking pretty good. WSC, WillScott, medical managed care. Commercial leasing is what WillScott is, and that looks pretty good because hiring's still strong. NOC, Northrop Grumman, I hope they don't know something about Ukraine and Russia that we don't, but the stock is holding up very well. Lilly, 2 pretty nice, important announcements over the last 2 weeks. That's why the stock's sitting on the 80 EMA. But we did sell our discretionary sale today on that, not a technical sale. LVS, Las Vegas Sands, made higher highs since China Macau reopened, showing some very clear accumulation. AEHR, this was the big move higher today that I spoke about earlier. WWE, I don't know that I could ever buy this, but for one thing, it's a little thin, and it seems like every time it takes 2 steps up, it takes a step and a half back. Just don't like the look of the chart from a historic standpoint, but that is a pretty decent cup and handle right now. Big accumulation on the right side of the base before this pullback the last couple of days. Michael has a theory that this is going to get bought out, but I don't invest based on buyout theories. CF, again, very strong stock over the last couple of weeks. Steel Dynamics, just hanging in there. And finally, gold. The stock did survive, sitting right on the 21-day exponential moving average. But gold stocks, Gave it up a little bit, but again, giving it up, it's still a flag if you look at it. Let's look at it from like on a 15-minute time frame, and you can see here's the move up and here's the flag. Maybe it's more apparent on a 30-minute. Yeah, there's the move up, there's the flag, only giving back a third of the move higher, which is very reasonable. And you can see like this, the 1550 was the breakout area, and it's back tested it several times and is holding it so far. But this is like at the goal line. So that's going to wrap it. As always, love to hear feedback from you. Email don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Did I bring up the chart to remind people why we do what we do here at Revere? It's to keep you out of these big drawdowns as you approach retirement. So here's where we are right now, January to September, high to low, maximum correction 25.6%. We're right now sitting at around 24%, and had a bad reaction today that got us back down toward that 25.6%. So discretion's a better part of valor right now. Wrapping up the week ending October 7th, this is Don Vandenbord telling it like it is. Remember, it's not how much you make in the market, it's about how much you can keep. Thanks for listening and have a great day.